Andre Roberts from Invesco Quantitative Strategies, welcome.
Thanks very much.
First question for you is, why should advisors be focused on risk-adjusted returns?
Okay. Because investors come to the equities market to be rewarded for risk. So advisors should be focused on ensuring that they spend their clients' tolerance for risk wisely. And the way to do that is to focus on factors that are rewarded with a return premium, and ensuring that you avoid exposure to unrewarded factors.
And what are those 4 factors?
4 factors, wow. Well, we like to think of it as primarily quality. So quality companies that offer sustainable earnings growth. Momentum. Now that can be a quant's definition of growth, if you like. So growth, sustainability, or even market price type growth. And finally, value, as in a relative value sense. And so in that sense, there's 3 key families of factors, if you like, that we focus on. Semantics, but momentum can be broken into earnings and price quality, price growth.
Excellent. And what should investors in Australian equities be worried about today?
Wow. I guess you want to avoid paying high fees for low alpha. So, I mean,
is that the perfect world?
High fees, yeah, certainly what you want to do. You want to avoid paying high fees for low alpha, right? That's the thing that you should be concerned about today. And from the conversations that we have with our clients, investors want to ensure that they're getting solid and reliable net of fee returns for the risk that they're willing to spend.
And you've got a unique take on diversification. Could you explain that for us?
Well, that's right. Diversification is not just owning every stock in the benchmark, because there's a lot more ways of getting better diversification than that. It's looking at all characteristics of risk and ensuring that you're spreading that risk wisely across those characteristics.
So you're looking beyond the single factor market capitalisation strategy.
Right. Yeah, we believe that there's more than one factor than just that one factor that drives returns. Clearly, as we've spoken about previously, it's finding quality companies that have reliable growth and that are priced attractively. They're the drivers of equity returns.
Maybe one last question. Can you explain the concept of tracking error for me?
Is a measure of relative risk. And so it's, in a technical term, it's a standard deviation of active returns. That'd be a measure of ex post risk. There's also forecast tracking error, which would be modelled by a risk model, like one of your vendors, Axioma or Barra. But in summary, it's a measure of active risk.
Excellent. Thank you, Andre.
Thanks very much.